Hello everyone, and welcome. I'm excited to have you here today. We'll be diving into how to master market analysis, valuation, and portfolio scaling to build long-term wealth. This is part of our professional diploma program in real estate investments. Over the course of this presentation, we'll explore key strategies and insights to help you succeed in the real estate investment world. Let's get started. On this slide, we focus on how we're equipping investors with the actionable knowledge they need to build a resilient property portfolio. The goal here is to empower you with practical insights and strategies that you can apply directly to your investments. By leveraging data-driven strategies, you'll be able to make smarter, more informed decisions that help you navigate market fluctuations and minimize risks. We'll be covering core modules throughout this course, which are designed to give you a comprehensive understanding of how to analyze data effectively and implement strategies that stand the test of time. These modules are the building blocks for developing a resilient portfolio, and they align with our overall mission of helping you succeed in the property market. Ultimately, the aim is to turn complex data into clear, actionable steps that you can take to optimize your investments and achieve long-term stability. So, as we move through this course, keep in mind that every piece of knowledge is a step toward building a stronger, more resilient property portfolio. Let's take a closer look at how values and rents tend to behave in relation to inflation. Typically, as inflation rates go up, so do the values of physical assets and the rents they generate. This makes them a useful hedge against inflation because their worth isn't eroded by rising prices. In fact, they often appreciate. When we talk about an inflation hedge, we're referring to assets that maintain or increase their value during economic uncertainty. Physical assets like real estate are prime examples because they provide a sense of stability when the economy is volatile. This concept ties into the idea of tangible value, assets you can see and touch, which have intrinsic worth. Real estate, in particular, stands out as a strong example of this. It's an asset class that's been proven to perform well over time, especially as part of a diversified investment portfolio. So, understanding the role of real estate as an asset class helps us see how it can serve as a reliable growth vehicle and a safeguard against inflation. It's not just about owning property. It's about leveraging an asset that can preserve and grow wealth even when economic conditions fluctuate. Now, let's take a closer look at the main types of real estate investments. We have residential, commercial, industrial, and land. Each of these categories offers unique opportunities and challenges. Residential properties are perhaps the most familiar. They include single-family homes, apartments, and condos. These are typically more accessible for individual investors and tend to have steady demand. Moving on to commercial properties, such as office buildings, retail centers, and shopping malls. These often require larger capital investments, but can generate higher returns through long-term leases. They also often involve different management and market dynamics compared to residential properties. Then we have industrial properties, which include warehouses, manufacturing facilities, and distribution centers. They are vital to the supply chain and often benefit from long-term tenants and stable cash flow. Plus, their demand has been growing with the expansion of e-commerce. Finally, land investment involves purchasing undeveloped or raw land. This can be a strategic move for future development or appreciation, but it also comes with its own set of risks, like zoning changes or market fluctuations. Understanding these different types helps us tailor our investment strategies to meet specific goals and risk tolerances. Recognizing the strengths and considerations of each category is key to building a diversified and resilient real estate portfolio. When it comes to choosing your investment approach, it really depends on a few key factors like how much time you can dedicate, your level of expertise, and how much risk you're comfortable taking on. On the passive side, we have options like REITs, syndications, and real estate funds. These are great if you want to invest in real estate without getting involved in the day-to-day management. They offer more simplicity and can be less demanding in terms of time and effort. On the other hand, active investing involves a more hands-on approach. This includes managing properties directly, handling renovations, and dealing with tenant relations. It requires more time, effort, and expertise, but it also gives you more control over your investments and potential returns. Understanding the difference between active and passive investing helps you align your choices with your personal goals and resources. Ultimately, your decision should match your risk tolerance, your available time, and your comfort level with managing properties directly or indirectly. This is crucial as we continue to explore how different strategies fit into your overall investment plan. All right, let's dive into some key investment terms that are essential for mastering this language. First up is leverage. This is a strategy where we use debt to increase our returns. Essentially, instead of investing all our own money, we borrow some to amplify the potential profits. But it's important to remember, leverage can also increase risks, so it's a tool that needs to be used carefully. Next, we have the cap rate. This is a measure of yield based on the property's market value. It helps us understand how much income a property can generate relative to its price. A higher cap rate usually indicates a higher return, but it can also mean higher risk. Then there's NOI, or net operating income. This is the income a property makes before accounting for any debt payments. Think of it as the pure profit from the property's operations, which gives us a clear picture of its earning power. Finally, as we're mastering the language of investment, understanding these core terms is crucial. They form the foundation of how we analyze and communicate about real estate opportunities. By grasping these concepts, we can make smarter decisions and better navigate the complexities of investment. Let's take a closer look at the different phases of the real estate market cycle: expansion, peak, contraction, and trough. Each of these phases plays a crucial role in understanding market dynamics. During the expansion phase, the market is growing, prices are rising, and demand is increasing. Then we reach the peak, which is the highest point of market activity, but it's also a critical moment where signs of slowdown might begin to appear. Following that is the contraction phase, where prices start to decline and activity slows down. Finally, we arrive at the trough, which is the lowest point in the cycle, but also a potential opportunity for recovery. Timing entry into and exit from these phases is absolutely essential for effective risk management. Knowing when to buy during a trough or sell at a peak can make a significant difference in your investment outcomes. Recognizing these phases helps us not only anticipate market changes, but also adapt our strategies accordingly, aligning with the overall goal of minimizing risk and maximizing returns in real estate investments. Now, let's take a closer look at analyzing neighborhood data and macroeconomic trends. This is a crucial part of our overall approach, because understanding both local and global market dynamics helps us make smarter decisions. When we talk about global and local markets, we're really looking at how economic factors at different levels influence property values and investment opportunities. On a broader scale, macroeconomic trends like interest rates, inflation, and employment rates set the stage for market movements worldwide. But equally important is the neighborhood data, things like local employment growth, infrastructure development, and community demographics. These details paint a more immediate picture of the opportunities and risks in specific areas. By combining these insights, we get a comprehensive view that allows us to identify not just current hotspots, but also emerging markets. This approach aligns perfectly with our overall theme of strategic, data-driven decision-making in real estate. So, paying attention to both macro trends and neighborhood specifics helps us stay ahead of the curve and make well-informed investments. Now, let's take a closer look at evaluating construction permits and absorption rates, which are crucial indicators of the supply and demand dynamics in our market. When we talk about supply, we're referring to the number of new construction permits issued, which tells us how much new inventory is coming into the market. On the other hand, absorption rates give us an idea of how quickly those new units are being sold or leased out, reflecting demand. By analyzing these two factors together, we can get a clear picture of whether the market is in a healthy state, overheating, or perhaps undersupplied. For example, if permits are high but absorption rates are low, it might suggest an oversupply situation, which could lead to downward pressure on prices. Conversely, if permits are low but absorption is strong, it indicates a high demand that could signal potential for future price increases. Connecting this to the overall theme, understanding these metrics helps us make smarter investment decisions, anticipate market trends, and identify opportunities or risks before they fully materialize. It's all about balancing what's being built with what's being absorbed to keep the market stable and healthy. Population growth and migration are key drivers of demand in this context. As populations increase, whether through natural growth or people moving from one area to another, the demand for resources, services, and infrastructure also rises. When we look at demographic indicators, we're essentially examining the underlying factors that influence these trends. These indicators help us understand not just how many people there are, but also their age, income levels, education, and migration patterns. All of these elements are crucial because they shape the overall market demand and economic activity. Connecting this to our broader theme, recognizing how population dynamics influence demand allows us to better anticipate future needs and plan accordingly. So, understanding these demographic indicators is fundamental to grasping the bigger picture of growth and migration impacts. Now, let's take a closer look at some of the key metrics we use to analyze the market. First, vacancy rates and rental growth are crucial indicators. Vacancy rates tell us how much of the available rental inventory is unoccupied, giving us a sense of supply and demand dynamics. Meanwhile, rental growth shows us how rental prices are evolving over time, which is vital for assessing investment potential and market health. To gather this data, we rely on platforms like CoStar, Reonomy, and MLS. These tools provide comprehensive, up-to-date information on property listings, occupancy rates, and rent trends. They help us make informed decisions based on real-time data. In addition, we use public data sources such as reports from the Census Bureau and the Bureau of Labor Statistics. These organizations offer valuable insights into broader economic and demographic trends that influence the rental market. All these resources, market research tools, and public data, form the foundation of our analysis. They allow us to understand current conditions and anticipate future shifts, aligning perfectly with our overall goal of making well-informed investment decisions. Let's take a closer look at some of the key factors driving growth. First, affordability. When we talk about affordability, we're really looking at the relative price-to-income ratios. This helps us understand how accessible housing and living costs are for residents, which is crucial for attracting talent and supporting local economies. Next, infrastructure plays a vital role. We're seeing significant investments in new transit systems and broadband projects. These improvements not only make daily commutes easier, but also connect communities more effectively, opening up new opportunities for business and innovation. Finally, the economy itself is becoming more diverse. With a broad range of industries and ongoing job creation, we're building a resilient economic foundation. This diversification helps ensure steady growth and stability, even when specific sectors face challenges. All of these factors, affordability, infrastructure, and economic diversification, are interconnected and essential for fostering high-growth markets. They support the overall theme of sustainable development and long-term prosperity. When it comes to determining accurate property pricing, we rely on a few primary methods. First, there's the comparable sales, or CMA, approach, which involves looking at similar properties in the area that have recently sold. This gives us a real-world benchmark for what buyers are willing to pay. Next, we have the income approach, which is especially useful for investment properties. This method estimates value based on the income the property can generate, helping investors see the potential return. Finally, there's the cost approach, where we consider what it would cost to replace or reproduce the property minus depreciation. All three methods, comparable sales, income approach, and cost approach work together to give us a comprehensive and accurate picture of a property's value. This multi-method approach is key to ensuring our pricing is both realistic and fair, fitting into our overall goal of precise valuation. Let's walk through the process of determining a property's value. First, we start with calculating the value itself, which involves analyzing various data points to arrive at an estimate. Next, we adjust that value for specific features of the property, things like upgrades, condition, and unique characteristics that can influence its worth. Then, we select comparable properties, or comps, that are similar in size, location, and features, to ensure we're making an accurate comparison. After that, we perform a comparative market analysis, or CMA, which synthesizes all this information to give us a well-rounded view of the property's market value. By following these steps, we ensure our valuation is thorough, accurate, and aligned with current market conditions. Now, let's talk about how we value assets based on net operating income and cap rates. This is a key part of the income approach, which is one of the main methods we use in property valuation. Essentially, we look at the income that a property generates, its net operating income, or NOI, and then apply a capitalization rate, or cap rate. The cap rate reflects the return investors require and the risk associated with that property. By dividing the NOI by the cap rate, we can estimate the property's value. This approach is especially useful for income-producing properties because it ties the value directly to the income potential. When we understand how NOI and cap rates interact, we get a clearer picture of a property's worth in the market. This method helps us connect the property's income performance to its valuation, making it a practical and insightful approach within the broader valuation process. Now, let's take a closer look at some of the key return metrics that are essential in real estate investing. First up is cash-on-cash return. This metric measures the annual return on the actual cash invested in the property. It helps us understand how effectively our cash is working for us each year. Next, we have ROI, or return on investment. This gives us a broader view of the overall profitability of the property, considering both the initial investment and the total gains over time. Then there's IRR, which stands for internal rate of return. IRR is particularly useful because it accounts for the time value of money, giving us an annualized rate of return that considers the timing of cash flows, both in and out. All these metrics, cash on cash, ROI, and IRR, are vital for evaluating different aspects of a property's performance. They help us compare potential investments, measure success, and make informed decisions aligned with our overall investment goals. Remember, no single metric tells the whole story, but together they provide a comprehensive view of the return metrics we need to monitor. Now, let's talk about stress testing investments under various market scenarios. This step is crucial because it helps us understand how our investments might perform during different economic conditions, whether it's a market downturn, a sudden spike in volatility, or other unexpected events. By simulating these scenarios, we can identify potential vulnerabilities and better prepare for them. Next, we move on to feasibility analysis. This is about assessing whether our investment strategies are practical and realistic given the potential risks and market conditions. It involves evaluating the likelihood of success and understanding the limitations of our assumptions. Connecting this to the overall theme, stress testing combined with feasibility analysis provides a comprehensive view of risk. It ensures that we're not only aware of potential challenges, but also equipped to make informed decisions that align with our risk appetite and investment goals. Ultimately, these tools help us build more resilient portfolios and enhance our confidence in navigating uncertain markets. Now, let's delve into understanding the different lending structures used for acquisitions, namely conventional, FHA, and commercial loans. Each of these has unique features and requirements that can impact how you approach financing. One of the key concepts we need to grasp is the loan-to-value ratio, or LTV. This ratio essentially compares the loan amount to the appraised value of the property, giving us a sense of the leverage involved. A higher LTV means more leverage, but also potentially more risk. When it comes to mortgage and lending, understanding these ratios helps you evaluate your options and align them with your investment goals. Whether you're looking at conventional loans, FHA programs, or commercial financing, knowing how LTV impacts your borrowing capacity and terms is crucial. It connects directly to the overall theme of optimizing your financing strategies to make smarter, more informed investment decisions. Now, let's talk about some additional strategies that can really enhance your investment approach: joint ventures and hard money lending. These are powerful tools, especially when traditional financing options might not be available or suitable. Firstly, joint ventures involve partnering with other investors or entities to combine resources, expertise, and capital. This allows you to take on larger deals or projects that might be out of reach on your own, while sharing the risks and rewards. It's all about leveraging collective strengths to achieve common goals. Next, we have hard money lending. This is a form of private financing where lenders provide short-term, asset-based loans, usually based on the value of the property rather than your creditworthiness. It's often used in rehab projects or quick turnaround deals because it can be faster and more flexible than traditional bank loans. Both strategies emphasize the importance of building relationships and trust within the private financing space. They also highlight the need for a solid understanding of the deal, the risks involved, and how to structure deals that are mutually beneficial. In the broader context of our presentation, these strategies expand your toolkit, giving you more options to fund and execute your real estate investments successfully. Now, let's talk about how we can use borrowed capital to amplify our returns while still maintaining a focus on cash flow safety. Essentially, this strategy involves leveraging our assets, using debt strategically to boost our potential gains. The key here is balance. We want to enhance our returns without overextending ourselves. The standard debt ratio we typically aim for is around 70%. This means that about 70% of our asset value can be financed through debt, leaving 30% as equity. Staying within this range helps us keep our leverage at a manageable level, reducing the risk of cash flow issues down the line. Leverage strategies like this are powerful because they allow us to do more with less capital. When used wisely, borrowing can be a tool to accelerate growth and improve profitability. But it's crucial to always keep an eye on our cash flow and ensure we can meet debt obligations comfortably. In the context of our overall investment approach, leveraging wisely aligns with our goal of maximizing returns while safeguarding our financial stability. It's about smart borrowing, using debt as a tool to amplify our success without compromising our cash flow safety. Now, when lenders evaluate a potential borrower, they focus on several key factors during the underwriting process. One of the most important is the debt-to-income ratio, or DTI, which helps determine if you have enough income to comfortably manage your loan payments along with your other debts. They also look closely at your assets, such as savings, investments, and other valuable property, to ensure you have a financial cushion. Additionally, the quality of the property itself plays a critical role, as it affects the collateral and the overall risk for the lender. Another crucial aspect is your credit score. Generally, lenders prefer a credit score of 680 or higher, as it indicates a solid credit history and a lower risk of default. This score can significantly influence your loan qualification, determining not only whether you qualify but also the terms and interest rates you might receive. So, in essence, lenders are assessing your financial stability and the property's value to make sure that the loan is a safe investment for them. Keeping these factors in mind can help you better prepare for the application process and improve your chances of securing favorable loan terms. Now, let's look at the importance of strategic timing when it comes to managing our debt. By refinancing at the right moment, we can lower our debt service obligations and also extract some of the equity we've built up. This approach helps improve our cash flow and strengthens our financial position. Refinancing is a key tool here. It allows us to adjust our debt terms to better suit current market conditions and our strategic goals. Another critical point is protection against rising interest costs over the long term. Locking in fixed rates can shield us from potential increases in interest rates that could otherwise inflate our expenses over time. This ties into the concept of interest rate risk. It's the danger that fluctuations in interest rates could impact our debt costs. By understanding and managing this risk, especially through fixed-rate financing, we ensure more predictable expenses and better financial stability. Overall, these strategies are about timing and risk management, making smart moves to optimize our debt structure while safeguarding against uncertainties in the interest rate environment. Let's talk about some critical legal considerations when it comes to protecting your real estate investments. On this slide, we're focusing on issues related to easements, ownership structures, and LLCs. First, issues can arise with easements, which are rights granted to others to use part of your property. These can impact your control and future plans, so it's essential to understand and carefully review any easements tied to your property. Next, ownership structures are key. How you hold title, whether personally, through a trust, or other arrangements, can affect liability, estate planning, and tax outcomes. Choosing the right structure is crucial for long-term protection. This leads us to LLCs, or limited liability companies. Setting up an LLC for your property can offer a layer of protection, isolating your personal assets from potential liabilities related to the property. It's a common strategy for investors to safeguard their personal wealth. Throughout this, the main idea is that understanding these legal issues and structuring your ownership properly can make a significant difference in how well your investments are protected. It's all about being proactive and strategic to preserve your assets and ensure smooth operations. Now let's look at the transfer process, which is a crucial step in ensuring a smooth transaction. When we talk about closing, it's not just about signing papers. It's about officially transferring ownership from the seller to the buyer. One of the first things we need to verify during this stage is the financial audit. This means checking the financial records to confirm everything is accurate and transparent. It's important because it protects both parties and helps avoid surprises later on. Next, we have to verify the physical condition of the property or asset. This involves inspecting the actual item or location to ensure it matches what was agreed upon in the purchase agreement. Speaking of which, the purchase agreement or contract is the foundation of the transaction. It outlines all the terms, conditions, and obligations that both sides need to follow. Lastly, due diligence is a comprehensive process where we thoroughly review all relevant information, financial, legal, and physical, to make sure there are no hidden issues. This step is essential because it gives both buyer and seller confidence that everything is in order before finalizing the transfer. All these points connect to the overall theme of protecting your interests and ensuring a seamless, transparent transfer process. Let's talk about zoning and compliance, which are crucial in any development project. First, compliance with ADA and local building codes is essential to ensure our projects are accessible, safe, and meet legal standards. It's not just about following rules, it's about creating spaces that are welcoming and usable for everyone. Next, density refers to the number of units allowed per acre or lot. This helps us understand how densely we can develop an area, balancing growth with community needs and infrastructure capacity. Then we have permitted use, which distinguishes between residential and commercial uses. Knowing what types of activities are allowed in a zone helps us plan effectively and avoid potential issues down the line. All these points, ADA compliance, density, permitted use, tie back to the overall theme of responsible and well-planned development. They ensure we're creating projects that are legal, practical, and aligned with community goals. Let's take a closer look at some tax strategies that can really make a difference in real estate investing. First up is the 1031 exchange. This is a powerful tool that allows investors to defer paying capital gains taxes when they reinvest the proceeds from a property sale into a similar property. It's like a rollover for real estate investments, helping you to grow your portfolio without immediate tax burdens. Next, we have depreciation. This is an accounting method that allows you to spread out the cost of a property over its useful life. By doing so, you can reduce your taxable income each year, which can significantly improve cash flow. It's an important strategy because it leverages the tax code to your advantage, making your investment more financially sustainable. Both of these strategies, 1031 exchanges and depreciation, are essential tools in the investor's toolkit. They connect to our overall theme of maximizing returns and managing taxes effectively. Using them wisely can help you preserve more of your profits and reinvest wisely for future growth. Let's take a closer look at some key strategies to protect your assets and ensure financial stability. First, we have the entity shield, which involves structuring your business or personal entities in a way that minimizes exposure to legal liabilities. This is crucial because it adds an extra layer of protection against lawsuits or claims. Next, the legal aspect is all about having solid legal frameworks in place, contracts, agreements, and proper documentation to defend your interests if issues arise. Moving on, an emergency fund acts as a financial safety net, allowing you to cover unexpected expenses without disrupting your overall plan. Reserves are similarly important. They provide liquidity and peace of mind, ensuring you have funds readily available for unforeseen circumstances. The market spread is a concept that refers to diversifying investments across different markets, which helps reduce risk by avoiding overexposure to any single area. Speaking of diversification, it's one of the most effective ways to protect your portfolio from volatility. Asset protection strategies, including legal structures and insurance, serve to shield your wealth from potential threats, whether legal or market-related. Insurance plays a vital role here as well. Think of it as a safety net that can help you recover from losses that could otherwise be devastating. Finally, risk mitigation encompasses all these strategies. It's about proactively identifying risks and implementing measures to minimize their impact. Together, these points create a comprehensive approach to safeguarding your assets, aligning perfectly with our overall theme of building a resilient financial foundation. Let's talk about appreciation first. When we invest, appreciation refers to the increase in the value of our assets over time. It's a key driver of wealth growth, especially with assets like real estate or stocks that tend to appreciate over the long term. Next, we have stable income. This is about generating consistent cash flow from our investments, such as rental income or dividends. Having a reliable income stream can give us peace of mind and financial security, helping us cover expenses without stress. Then there's buy and hold. This strategy involves purchasing investments and holding onto them for the long haul, rather than frequently buying and selling. It's based on the idea that markets tend to grow over time, so staying invested allows us to ride out the fluctuations and benefit from overall growth. Connecting these points to our overall theme, these concepts emphasize a disciplined, long-term approach to building wealth. Appreciating assets, generating stable income, and holding investments for the long term can lead to financial stability and growth over time. When it comes to short-term profit strategies through renovation, one popular approach is the fix and flip model. Essentially, this involves purchasing a property that needs some work, making targeted improvements, and then quickly reselling it for a profit. The key is to identify homes with potential where the renovation costs are manageable and the resale value is significantly higher. It's about finding that sweet spot, adding enough value through renovations to maximize your return without overinvesting. This approach aligns well with the overall theme of leveraging real estate for strategic gains, especially when time is of the essence. It's a dynamic way to generate quick profits while also improving properties and communities. Let's talk about maintaining our high standards for service to keep our high-value tenants satisfied. Providing quality service is essential because it encourages tenants to stay longer and feel valued. When tenants feel well taken care of, they're more likely to renew their leases, which stabilizes our occupancy and income. Next, retention is a key focus. By offering excellent service, we build strong relationships that foster loyalty. Keeping our current tenants happy is often more cost-effective than constantly seeking new ones, and it contributes to a positive reputation for our property. Now, to support this, we use market-based rates. Setting rents in line with current market conditions helps us minimize vacancy periods. If we price too high, we risk losing tenants or having units sit empty. Too low, and we might leave money on the table. Finding that right balance is crucial. And that brings us to pricing strategy. Our goal is to optimize rental income while remaining competitive. This requires ongoing analysis of market trends and adjusting rates accordingly. Finally, effective rental management ties it all together. It involves not just setting the right rates, but also ensuring smooth operations, responsive communication, and proactive tenant engagement. When we manage rentals well, it all contributes to tenant satisfaction and retention, aligning perfectly with our overall objective of creating a stable, profitable property. Now, let's take a closer look at logistics and e-commerce fulfillment centers. These are a crucial part of the industrial sector, primarily because they experience high foot traffic and are driven by consumer demand. Essentially, these centers are the backbone of online shopping, ensuring products move efficiently from warehouses to customers' doorsteps. Moving on to retail assets, these typically involve long-term leases with corporate tenants. These properties are stable sources of income, often anchored by well-established brands that commit to extended agreements, providing predictability and security for investors. Lastly, we have office and other commercial assets. These properties serve as essential spaces for businesses, fostering professional environments and supporting economic activity. Overall, understanding these different types of commercial assets helps us grasp how diverse the real estate market is and how each sector plays a unique role in the broader economy. Now, let's talk about diversifying across different property types and geographies. This is a crucial strategy for scaling your portfolio effectively. By spreading your investments across various property types, like residential, commercial, or industrial, you can mitigate risks associated with market fluctuations in any one sector. Similarly, investing across different geographic regions helps protect your portfolio from regional economic downturns or localized issues. The key here is to build a balanced mix that aligns with your overall investment goals. Diversification not only helps manage risk, but also opens up opportunities for growth in different markets. When done thoughtfully, it allows you to tap into multiple income streams and capitalize on regional trends. Remember, the goal of scaling your portfolio isn't just about increasing size, but doing so wisely. By diversifying across property types and geographies, you're positioning yourself for more sustainable, long-term success. This approach is essential as you look to expand and strengthen your real estate holdings within the larger strategy we've been discussing today. Now, let's move on to the importance of screening for stability and reliability when it comes to tenant selection. This is a critical step because it helps us identify tenants who are likely to pay rent on time and maintain the property well. By carefully screening, we can reduce the risk of late payments or potential damage. The goal is to find tenants who are responsible and dependable, which ultimately supports the overall success of our investment. Remember, thorough screening connects directly to the overall theme of creating a stable and profitable rental operation. So, taking the time to assess each applicant carefully can make a huge difference in the long run. When it comes to maintaining a reliable network of contractors and services, it's all about building strong relationships with trusted vendors. These vendors are essential partners who help us ensure everything runs smoothly. By scheduling regular checks, we can catch potential issues early on, which helps us avoid costly repairs down the line. This proactive approach falls under preventive operations and maintenance, which is key to keeping our systems efficient and minimizing downtime. Overall, having a dependable network and a solid maintenance plan supports the overall health and longevity of our operations, aligning perfectly with our goal of delivering consistent, high-quality performance. Let's talk about how we can reduce utility costs by incorporating green technology. Focusing on efficiency is key here, as smarter energy use not only lowers expenses, but also supports sustainability. When we modernize kitchens and bathrooms, we're not just making the space more appealing. These upgrades can lead to higher rent and attract tenants who value quality and eco-friendly features. Upgrades like energy-efficient appliances, LED lighting, and water-saving fixtures are excellent examples of value-add strategies. They enhance the property's appeal while also improving operational costs. Ultimately, these approaches tie into our overall goal of maximizing property value while being responsible stewards of resources. By investing in green technology and strategic upgrades, we're creating a win-win situation for both tenants and our bottom line. Let's talk about tracking occupancy, rent collection, and cash flow. These are crucial components for effective performance monitoring. Keeping a close eye on occupancy rates helps us understand how well our properties are being utilized and if there are any vacancies that need addressing. Monitoring rent collection ensures we're maintaining steady income and catching any late payments early on. And tracking cash flow gives us a clear picture of our financial health, helping us make informed decisions and plan for the future. By consistently monitoring these key areas, we can identify issues quickly, optimize our operations, and stay aligned with our overall goals for success. Now, let's turn our attention to strategic disposition and capital recycling, particularly focusing on exit planning. When we talk about exit planning, we're essentially discussing how to effectively manage the process of divesting or exiting an investment or asset. This is a crucial component because it directly impacts our returns and how well we can reinvest capital into new opportunities. The key point here is that a well-thought-out exit plan allows us to maximize value and minimize potential risks. It involves carefully timing the exit, understanding market conditions, and choosing the right method, whether that's a sale, an IPO, or another exit route. By strategically planning our exits, we also create opportunities for capital recycling. That means we can free up resources from successful investments to fund new ventures, maintaining a healthy cycle of growth and reinvestment. Connecting this to the overall theme, effective exit planning and capital recycling are essential for optimizing our portfolio performance and sustaining long-term growth. It's about being proactive, strategic, and disciplined in how we manage our investments from start to finish. Now, let's turn our attention to identifying market and financial threats that could impact our investment strategy. When we talk about investment risks, we're really focusing on the potential obstacles that could threaten the success of our investments. These risks can come in many forms, such as market volatility, economic downturns, or changes in regulatory policies. It's crucial to understand these risks thoroughly because they directly influence our decision-making process. By recognizing these threats early, we can develop strategies to mitigate their impact. For example, diversifying our portfolio can help cushion against market swings, while staying informed about policy changes can prepare us for regulatory shifts. Ultimately, understanding and managing these investment risks aligns with our overall goal of safeguarding our assets and ensuring steady growth. So, in this part of the presentation, I want you to keep in mind that identifying and understanding these risks is essential to making informed, confident investment choices. Now, let's talk about defensive positioning and opportunistic acquisition as part of recession strategies. When the economy is slowing down, it's crucial to adopt a cautious stance. This is what we mean by defensive positioning. Essentially, it involves protecting your existing assets and maintaining stability, rather than taking unnecessary risks. At the same time, recession can also present unique opportunities. Opportunistic acquisition means being ready to identify and act on undervalued assets or companies that may be struggling, but have strong fundamentals. This approach can allow us to strengthen our portfolio and position ourselves for growth once the economy picks up again. Connecting this to our overall theme, it's about balancing caution with strategic opportunity. By positioning ourselves defensively, we safeguard our current investments, but we also remain alert to opportunities that can give us an advantage in a challenging economic environment. This balanced approach is key to navigating recessions effectively. Let's now turn our attention to sustainability and social responsibility in real estate, a topic that's increasingly important in today's market. One key aspect of this is ethical investing. When we talk about ethical investing, we're referring to making investment choices that align not only with financial goals, but also with values like environmental stewardship and social impact. It's about selecting projects and properties that promote sustainability, reduce environmental harm, and support communities. This approach encourages developers and investors to prioritize green building practices, energy efficiency, and social equity. It's about creating long-term value while also doing good. As we've seen throughout this presentation, integrating these principles helps build resilient, responsible portfolios that benefit both investors and society. Ethical investing is really at the heart of responsible real estate development and aligns perfectly with the broader goals of sustainability and social responsibility. Let's talk about PropTech and data analytics as a way to gain a competitive edge in the real estate industry. This slide highlights how technology is transforming the way we operate and make decisions. Real estate tech, or PropTech, is all about leveraging innovative tools and platforms to improve efficiency, transparency, and customer experience. By harnessing data analytics, we can gain deeper insights into market trends, customer preferences, and operational performance. This combination allows us to make smarter, more informed decisions faster than ever before. It's about staying ahead of the curve and using technology not just to keep up, but to lead the way in a competitive market. Ultimately, integrating PropTech and data analytics is essential for gaining that critical edge and evolving with the industry's rapid digital transformation. Let's take a closer look at what makes REITs unique. First, the exposure. Investing in a REIT gives you passive access to large-scale real estate assets, meaning you don't have to be involved in the day-to-day management, but still benefit from the property's income. Next, the dividends. REITs are required by law to pay out at least 90% of their taxable income to shareholders, which often translates into attractive, regular income streams for investors. And then there's liquidity. Unlike direct real estate investments, REITs are traded on major stock exchanges, so you can buy and sell shares just like you would with stocks. All of these points tie into the overall theme of REITs being a convenient, income-generating, and liquid way to invest in real estate without the typical hassles. Now, let's talk about managing currency risk and cross-border laws, which are crucial when dealing with international markets. As businesses expand globally, they face the challenge of fluctuating currency exchange rates that can impact profitability. It's important to understand how currency movements can affect costs, revenues, and overall financial stability. To mitigate these risks, companies often use financial instruments like hedging to lock in exchange rates and protect themselves from adverse movements. Additionally, understanding local laws and regulations is essential. Different countries have varying rules around foreign investments, taxes, and trade practices, which can influence how you structure your operations and transactions. Connecting this to our overall theme, effectively managing currency risk and cross-border legal issues is vital for successful international expansion. It helps ensure smooth operations, financial predictability, and compliance with local laws, ultimately supporting sustainable growth in global markets. Building relationships with brokers, lenders, and fellow investors is absolutely essential in this industry. These connections are the backbone of your success because they open doors to opportunities and resources that might not be available otherwise. Industry connections, whether through networking events or online communities, help you stay informed about market trends and new deals. Professional networking isn't just about collecting contacts. It's about building genuine relationships based on trust and mutual benefit. When you foster these relationships, you gain access to valuable insights, advice, and support that can make or break your investment journey. Remember, the more you invest in these relationships, the more they pay off over time. They can lead to partnerships, funding opportunities, or insider knowledge that keeps you ahead of the competition. So, keep nurturing your industry connections because they are a critical part of not just surviving, but thriving in this field. Building long-term wealth through disciplined practice is really the cornerstone of a successful investment career. When we talk about your investment journey, it's essential to recognize that consistency and patience are key. It's not about quick wins or chasing the latest trend, but about making steady, informed decisions over time. This disciplined approach helps you navigate market fluctuations and avoid impulsive reactions. Remember, wealth building is a marathon, not a sprint. By staying committed to your strategy, continuously learning, and practicing good financial habits, you set yourself up for lasting success. Ultimately, your dedication and discipline will be the greatest drivers of long-term growth and financial security.